Joining me now from Denver to break down the April mortgage monitor is Andy Walden. He's Vice President of Research and Analysis at NYSE. Andy, it's always great to have you on the show, especially as we start new months. And what are the biggest takeaways that readers should gauge from this latest report?
Yeah, good morning, Chris, and thanks for having me back. In this month's report, we really took a deeper dive at what's going on in the U.S. housing market entering the spring home buying season. And what we found was growing levels of inventory almost universally across the country, softer levels of home price growth. So if you look at our ICE Enhanced Home Price Index, what you see is home price growth cooling from 3.4% in January down to 2.7% in February and down to 2.2% if you take an early look at March home prices. And so you are seeing that growth rate start to cool off out there in the housing market. Another key takeaway was the noticeable divergence that we've seen in the condo market, with condo prices actually in March slightly below where they were at this point last year. And that's the first time we've seen a year-over-year decline in condo prices since 2012. So a softer home price dynamic out there as we enter the spring buying season.
Interesting. Now, mortgage rates we've seen have been moving lower in recent weeks, Andy. Should we expect that trend to continue?
That's a great question. And if you look at where mortgage rates were being offered late last week, it was about 6.5%. It was the lowest mortgage rates that we've seen since October. And so as the market has moved from equities over into bonds and 10-year yields have come down, mortgage rates have come down a little bit as well. Now, when you start to look at the outlook for the remainder of the year, the place that I really like to look is at the ICE futures market and look at where 30-year mortgage rate futures are trading. If you look at those prices right now, what that infers is that the market is pricing in mortgage rates to come down another roughly 0.25% as we move through the next 6 months, getting down to the 6.25% range roughly by September. Now, obviously, a lot of moving parts here in the market, as we know, but that's currently what's being priced out there in the futures market.
So typically, Andy, we see lower rates. They can lead to higher prices and vice versa. Does the latest data support that stance?
Yeah, it's a good question, right? As I mentioned, we're seeing home prices cool off a little bit. Now, what I would say is that if you look at kind of inflection points that we've seen in the market, as interest rates have gotten into that 6.5% range or low 6% range in recent quarters, what you've seen is demand will pick up a little bit, prices will firm up a little bit as well. What's a little bit different this time around is we have more supply out there in the market than we have in the past. In fact, we're sitting in the best position that we've been from a supply standpoint in the last 4.5 years. The other question mark, obviously, in the market right now is how do prospective home buyers respond to what's going on in the broader market? Do we see any pullback in sentiment or demand, and do we see any impacts on the labor market? So certainly, the potential to see a little bit of firming of prices and interest rates come down, but there are some counter effects in the market right now as well.
So for our viewers trying to time the market, Andy, can be tricky at times, but what should they know about the relationship between the 10-year Treasury yield and mortgage rates?
Yeah, and as you know, 10-year Treasuries, mortgage-backed securities, mortgages are competing investments for fixed income investors out there in the market. And so those yields tend to trend along with one another. Now, obviously, there's a spread between those two. 10-year Treasuries are thought of as risk-free investments to the federal government, whereas mortgages have both duration risk as well as potential default risk associated with those if home buyers aren't able to pay those loans back. And so they tend to trade at a spread. And that spread's a little bit wider right now. As of Friday, it was about 2.5%. So we haven't seen the full decline that we've seen in 10-year Treasury yields make its way into mortgage rates. The mortgage rates have come down 1/8 to 0.25%. They give you a pretty good barometer if you're looking at those 10-year Treasury yields of what's going on in the mortgage market.
So with rates falling, Andy, after we had seen them remain pretty sticky for some time, are you seeing more people attempt to refinance?
Yeah, not quite yet, but the refinance market becomes very interesting here as we make our way through 2025. And the reason behind that is, if you look at what's happened over the last 2.5 years, we've now seen 13 million mortgages taken out since the middle of 2022 when the Fed started to raise interest rates. That's 1 out of 4 mortgages in the U.S. We've got about 60 to 70% more loans right now that have 7+% interest rates or 6.5% plus interest rates than we had at this point last year. And so there is some refinance incentive sitting out there if interest rates start to come down. The largest distribution of mortgage holders or homeowners are sitting there right at the high end of the 6% rate threshold, right at 6.875%. So really it's if we can entice those borrowers, if rates get low enough to incentivize those borrowers to refinance, then you can see some additional refinance volumes coming into the market.
How far do rates usually need to fall before we see that sort of activity really ramp up in the refinancing space?
It's a good question, right? And there's no perfect rule of thumb there. It varies a little bit depending on how large your loan amount is. For folks that are in a jumbo mortgage or live in more expensive markets, maybe it takes a little bit less interest rate incentive. It could be 1/4 to 0.5%. For folks that live in more affordable markets, maybe you've got $100,000 to $200,000 mortgage, it could take you over a full percentage point of interest rate incentive to refinance. Where we really start to see volumes pick up is right around 0.75%. If you can drop your mortgage rate by 0.75%, we start to see refinance activity pick up. We start to see prepayment speeds pick up in the capital market sector as well.
So with spring buying season on the horizon, Andy, where are we seeing a flush of inventory and perhaps inventory that isn't necessarily yet as loose as other areas?
Yeah, it's a good question, right? If we look at growth over the last 12 months, California markets have started to see inventory return a little bit. Those are some of the higher growth markets in terms of overall inventory levels. Where we look at markets that have seen inventory return to or above pre-pandemic levels, it's really the Sun Belt region of the country up through Colorado, right? You're seeing about 18 of the 100 largest markets that are now 15% above pre-pandemic levels in terms of inventory. Not surprisingly, those are the markets where you're seeing home prices a little bit cooler. And in fact, in some areas, you're seeing home prices come down from where they were at the same part last year or same time last year. In the areas where you're seeing deeper inventory deficits, it's really the northeastern region of the country and the midwestern region of the country. And no surprise there, in areas where you still have deep inventory deficits, you're still seeing firmer home price dynamics.
Andy Walden, head of mortgage and housing market research at ICE, joining us from Denver. Andy, always good to see you. Thanks so much.
All right, thank you, Kristen.
Yep.